Logan Hertz with Hazeltine LLC. We have back with us again our guest, Brad Owens, the resident expert on healthcare and health insurance and health sharing. Brad, how are you doing?
Doing great. Thanks for having me, Logan.
So, Brad, I think we're going to talk about a change that's coming that's going to impact a lot of people with the subsidies available for health insurance. You want to talk about what's coming and how it's going to impact people?
Yeah, sure. I think there's starting to be a little bit of media coverage on this, but it'll get greater as 2025 goes forward because starting in 2026, for anybody enrolled in marketplace coverage or thinking about enrolling in marketplace coverage, there are going to be huge is not a good enough word for it, titanic changes that are going to impact the affordability and access to insurance options for health insurance. This is not if you get coverage through work. This is not if you are part of a health sharing organization. This is not part of if you have Medicare, or this is only for those that get health insurance through the marketplace, which is a lot of people. Roughly 25 million Americans get their health insurance through the marketplace. So it's fourth on the list, but besides Medicare, Medicaid, and employer coverage, marketplace is next in line. And the changes coming are as big as any since the start of the ACA, since it began. The thing that'll impact the most people here is what's called the subsidy cliff. Now, what is the subsidy cliff? If you see it somewhere, maybe this conversation will make that a little bit easier to comprehend. But essentially, what it is, when people go to the marketplace and they apply for health coverage, your income is taken into consideration. And so, as you might imagine, those with higher incomes pay a little bit more. Those with lower incomes pay a little bit less. And during COVID, there was an update to the amount of help given to just about everybody who had one of these marketplace plans. They were called enhanced subsidies. There was also a tether put in during that time to affordability. So, what does that mean? It means that prior to the expansion of subsidies, government was interested in when trying to decide how much you would get or not get was how much you made relative to the federal poverty level. So if you made more than four times the federal poverty level, which to give an actual number, if you're a household of four times the federal poverty level is about $128,000. So if you had a household of four, you made more than $128,000, you weren't getting any help. Now, during COVID, they said, we understand the intent of the original law, but one of the things it didn't take into account is that a health plan varies by age. So the cost of health insurance, the raw cost before any subsidies or any of that are applied, is based on where you live and how old you are. Still guaranteed issue, and it doesn't matter what state of health you're in. Those are all things that stayed the same. But they said it's not fair that people of the same income have to pay more just because they're older. And so what happened was an affordability tether. So it changes a little bit every year, but roughly 9% of household income is the maximum you would be expected to pay currently on the marketplace. And there's no upper limit to income. So that 9% could be if you have a large family and your income's $250,000 a year. I have clients that are in that situation and still get help with their insurance because the cost of it would exceed 9% of their household income. So all that made a lot of logical sense to guys like me who had been in this business for a long time, because if you go work for a large employer, that employer is required to make you that coverage affordable. And the affordability is about 9%. And so the government applied the rules that they were pushing on employers to their own marketplace where individuals went and got insurance. So all this made sense. And small business owners were the biggest people that improved their lot in this situation. I've had many small business owners that I'd talked to in the past re-engage with them. And last time we looked, the coverage for your family was $3,000 a month. But with these expanded subsidies, now it's more affordable. But all of that sunsets through an act of Congress, not executive order. It was done through Congress. So the money was there, funded to the end of 2025. There is no chance or very little chance that this expanded subsidy and the tether to affordability continues into 2026. So if you have a plan right now, the price is going to stay the same. Assuming your income stays the same, it's going to stay the same the rest of 2025. So no problem for the next 8, 9 months. However, when we get closer to 2026, then a lot more people will start talking about this because people could get crushed with these changes. And let me give you a defined example. A married couple in their 60s, maybe a spouse works or they both work part-time, but they don't get offered coverage through their job. So they're getting their coverage through the marketplace and riding it out until Medicare becomes available to them at 65. These two people in their early 60s are by no means rich. They're making $85,000 per year. Okay. They were paying for the lowest cost plan in 2025, $84 a month. Very affordable for both of them. In 2026, that cost goes to $1,714. They're being asked to pay $20,000 a year in health insurance premiums, and that's the lowest cost plan available. So this is going to be an extreme situation where, it went from being that 9% of income to 25% of their income. And it's going to delay retirement for a lot of people because I work with financial advisors and they have clients who have done the right things and are looking to retire while they still have a good amount of health and life and vitality and do things that they put aside, raising the kids, working, families, all that. Everyone's dream of retirement that you get to enjoy the closing stage of your life and making that start earlier, understand that impulse. Up until now, that's been a doable thing with that tether involved, but that's going to change. I consult people every day that are considering retirement. Many of those people will delay it because of the cost of health insurance. When you add an extra $20,000 a year to your standard cost for some of these people, that's more than their house note. I know I can speak for my father. My father was in this exact situation 10 years ago, and his health insurance premium when he was 64 years old was $500 a month more than the house note. So it's really going to burden the people once you get 50 plus, where the health insurance premiums start going up considerably. It's going to impact them. It's also going to impact small business owners dramatically. Those with younger small business owners with families that have good incomes, but they're not in a small business that they can afford to offer a group policy. So in these situations, you're going to have an increase in cost of 10, 15, $20,000 a year for insurance premiums. What can you do about it? Well, there are a few things that I would consider before 2026 gets here. I would consider what other options long term there may be. And I would also consider what you could do today to make those options more viable. We've talked extensively about health sharing and what that looks like, the fact that there's no government involved. So changes year to year are much more stable. There's not these, hey, you get a new administration, radical changes come down the line. There's none of that because it operates outside of government money. If somebody is thinking about this, worried about it, nothing hurts to take a look now. can help you take a look at what your options may be. There is some optimism out there, Logan, that there might be some other options that will come to market prior to September of this past year. There were some lower cost options. They're called short term plans, but they were allowed to go on as long as 3 years. So for somebody that's approaching Medicare age, if they're 62 and just need something to ride out until they're 65, been something that they could consider. The previous administration declared by executive order that those were not compliant. And so they capped the term of a short term plan at 4 months. There is some optimism that that will get rescinded and that those may be a separate option because they're much less expensive than an unsubsidized where you're getting no help in the marketplace.
Okay. So it sounds like there's increasing costs coming to a segment of the population because of subsidies being rolled back, and you need to schedule time with myself or Brad to look at your situation if you're impacted by that, see if there are alternatives. And it seems like health sharing could be one, if you're reasonably healthy, and then potentially some of these short-term alternatives as well if you don't need coverage for a long period of time. Are there any options for people who are not healthy, or are they stuck?
Yeah, it depends on what you mean by not healthy. I'll give you an example. A lot of the health share organizations will allow people with diabetes, high cholesterol. Some don't care about body mass index, high blood pressure. The example I use quite frequently is if you have a bad shoulder and you need a surgery. If you go into a health share year one, they're going to exclude coverage for that surgery for the first year and then phase in coverage over time. And then anything that's new will be covered. However, if you're in the most dire of situations, if you have stage 4 cancer or you have an issue that you need immediate and ongoing treatment for, the marketplace is still the only guaranteed issue, covers everything and all comers available in that individual market. So there will be people who have no choice but to go marketplace. I think the ones that do have choices will vote with their pocketbooks, do rational, sensible things, and look for other viable alternatives. Unfortunately, that is what we call a doom loop in healthcare. The doom loop is that the insurance gets more expensive. So only the ultra sick, the people who will actually have to have it, will participate. And so you have an adverse selection issue that comes through. And what does that do to health insurance? It makes it more expensive. Carriers will leave the market. I fully expect if nothing's done, you'll have many carriers leave the market, maybe not as early as 2026, but certainly 2027 beyond. It is estimated, Logan, by Kaiser Family Foundation, the marketplace they project will lose about 15% of its participants per year until 2030. That's a long way out in the future and a lot of bodies coming off of that marketplace. And if I'm United Healthcare, I'm worried that whoever's going to be left in the marketplace are going to be very expensive to cover. So I'm going to be taking a margin of safety with my rates. I'm not going to be competing hard with rates. And then I'm also going to consider areas where certain states where it may not make sense at all to be in the market. Another change that's coming. So that's the top line change. The other changes that are going to be impactful are the open enrollment period is going to get contracted by a full month. Right now, the federal marketplace open enrollment, the annual time where you can make changes, change plans, get on a plan, get off a plan, all that sort of thing. That's from November 1st to January the 15th. Now that's going to 2025 for the 26 plan year will start November the 1st and end December the 15th. So you'll have a full month less to make decisions. And unfortunately, with the other cuts to HHS, which is Health and Human Services that oversees the marketplace, there will probably be less help out there. Folks like you and I will be super busy because we're trying to do 3 months worth of work in 6 weeks. So, to whatever degree you can plan that out ahead and we can look at things in advance, I think will be helpful. Have a plan ready to go. The other things that are going to happen, and I'll make quick mention of these, a thing called the family glitch. And that was something that got fixed in 2022 where Logan, let's say you worked for an employer and they covered you very well with your insurance costs, and maybe it was $100 a month for you to get coverage, but to add your spouse and your children was 1,500 extra dollars a month. They covered nothing towards the cost of your spouse and children. Prior to 2022, your spouse and children had no other options. They could not go to the marketplace. They could not get a subsidy. They were stuck with your health plan or finding a health share or something outside of it. That was changed in 2022. Those updated regulations are going to get rolled back. So we're likely going to go back to where if your spouse is offered coverage through your employer, that they've got to take it or they get nothing through the marketplace. They don't have an option to get a subsidy through the marketplace. And I think that's another consequence that could raise costs for families tremendously. The other one I'll mention is citizenship. They're lawfully present was the term described to who's covered, who's not. So lawfully present, that's people in certain visa categories, not just U.S. citizens. That will be rolled back. And so you're going to have a social security number. People with green cards would typically qualify, but you can't just use a visa number. For instance, one of the ones we get commonly is spouses of international students that come here with their spouses who are students. It's called an F2 visa. And those F2 visa people, their spouses are not allowed to work. They are not able to get a job and get coverage anywhere else. So it made sense to allow them to participate in the marketplace. That's likely coming to an end too. So there's going to be a general crackdown on special enrollment periods, on documentation. So if you submit, hey, my income is X, Y, or Z, they're not just going to take your word for it. Going forward, they're going to make you submit pay stubs and tax returns. There's a lot that's going on with those changes. And frankly, none of them are going to make sure more people get coverage. So I think to the degree which you look outside of the marketplace, for the working poor, not a whole lot's going to change. If you're making less than 400% of the federal poverty level, you may pay a little bit more. To go back to what that means, federal poverty level for a single individual, that's in 2025, $15,650. So for a single individual, that's the federal poverty level. And that same individual we get a subsidy to cover the cost of their health insurance to about $60,000. But if you make more than that, you'll get nothing. So regardless of the cost of your health insurance is, I would be less concerned if I was a person under the age of 35 or 40, maybe. I'd be less concerned if I was at the lower side of the income spectrum. I'd be much more concerned if I was a small business owner. I'd be much more concerned if I was a person above 50 years old.
So thanks so much for the update, Brad. As you can see, there's going to be some major changes coming, maybe time to consider some alternatives, time to talk to people like Brad and myself and see if we can do something to help control the cost of healthcare for you and your family and your employees. Thanks so much for your time, Brad. We hope we can help our clients with these new changes.
Absolutely. Thank you.